We're here to talk about Silicon Valley real estate market on November 23rd. Here's sort of the key chapters, the description of them down here, the tables, they're in order. So chapter one, two, and you can jump to each one of those timestamps in the description below on YouTube. Here's the first summary slide. What we're doing here is we're simply looking at some key indicators. We're looking at it where it was 13 full weeks ago and where it is currently today. Basically, this is inventory. So we're basically following the normal pattern. The normal pattern is going to be the thin gray line, and you're on the low side of that, which means there's a lack of inventory. We're about 15, 13% less inventory than you expect for this time of the year. Same concept for the number of offers accepted. Here, the number of offers accepted is significantly lower at the beginning of the moving quarter. And then over here, it's still lower than normal, but you've picked up 6%. You've gone from 74% to 80%. And so you still have a lack of inventory, but you've crossed over. The blue line is the least amount of offers accepted you'd expect. So we're no longer in the record low territories that we were just, you know, 10 weeks ago, but we are still on the low side of the number of offers, the number of transactions. Days of unsold inventory is seller buyer balance, the speed of the marketplace, sort of, how much pressure do the buyers feel when they're out there in the marketplace. And you can see that's been basically right on the normal line. There was a little bit of deviation, but only for a couple weeks. And right now we're at 99% of where we are. So we're 1% faster because lower numbers are faster marketplaces. So it's a little bit more competitive than normal, but at 99%, no one's going to see that. This is basically normal. There's going to be a bigger change just because Thanksgiving is as late as it possibly can be this year. The next summary graph is days on to market your property. This is how long it takes 75% of the sellers, 3 out of 4 sellers, to get an offer in on their property. Not to close escrow or anything like that, but simply how long it's taking to get the offer in. And you can see that's currently at 32 days. You're at 98% of normal. So, and you can see you're right on top of the gray line. So again, an absolutely normal marketplace. Now we're looking at price reductions, and this is a good indicator because, it's one that the sellers don't want to do. But if as the number of price reductions increase, clearly the market is slower. They're essentially taking a 1%, a 0.95% price reduction. And the reason that number is so small is the vast majority of the sellers, like somewhere around 85% of the sellers, do their homework, price their home correctly, they come on the marketplace and they sell quickly, all without having to adjust the price. So it's 15% or so of the sellers that are making roughly a 1% average price reduction. So that means that 15% is making a price reduction closer to 7% off their original ask price. Compared to normal, it's 88% of the normal amount, so it is a little bit less than normal. So that favors the seller. So it's on the hot side, the red side of the normal line. So you can see that we've gone just slightly above a slightly favorable seller marketplace in the last couple weeks. You go back to the beginning of the 13-week period of time, and we were slightly favoring the buyer because price reductions were slightly larger than normal. And overbidding has been consistently aggressive. We started off here at 5.7%, which is above the normal amount of overbidding. And normal amount of overbidding is 5.2, so 10% higher amount of overbidding. Now the amount of overbidding has remained the same at that 5.7% overbidding, but normally because of the end of the year holidays, the normal amount of overbidding is only 4.2%. So now you're 1.5% overbidding more than normal. And this is going to be the average overbidding. I do sometimes quote the median overbidding and sometimes I quote the average. So you do have to pay attention, but this is the amount of average overbidding. The median overbidding would probably be around 3.5%. Again, this is a quick summary of the key indicators where we're doing. And basically the summary I would say for this week is the market's behaving exactly where you'd expect it to be for this time of the year, which is a time of the year when there's not a lot of inventory, there's not a lot of transactions. Real estate is an optional event. People are busy doing other things and not worried about real estate. Here's the three key components on the long-term graph. We go all the way back to 2014, all the way up through January 1st of 2023. We're on this condensed scale, so you can get all 10 years in here. It's 9 years on the condensed, 1 year expanded, and then the current year also expanded. I will be adding one more year. I will probably be dropping off 2014 unless anybody reaches out to me and can give me a reason to keep data that far back. I find that people remember sort of the last couple years only, and that's one of the reasons I want the longer term data. It's also the data that I'm using to come up with the 10-year median so you can see how much the data fluctuates during that time frame. So anyway, inventory is the purple line down here. You can see that we're about 88%, 87.5% of the inventory you'd expect it to be. You can see it's been bouncing. The long-term trend has been probably been up. Clearly, there was a decrease in the amount of inventory in third quarter, but it's rebounded on the low side. And you can see it's been basically on the low side ever since we've had the shelter-in-place pandemic. Before that, we were basically normal. We really have had two different marketplaces before the pandemic and after the pandemic. As we get further away from the pandemic, if the current trends don't change, the data will become more and more normal, just because I'm using the recent past data for my normal. Moving on to the orange line, that's the number of offers. You can see the number of offers is at 80%. So the number of offers is less than the percentage of inventory. So for those that are trying to claim that we're in an inventory limited marketplace, that's not possible because we have 80% of the offers and we have 88% of the inventory. So there's more inventory than normal. Where you want it, where you could possibly have had an inventory limited offer is back here where inventory, the purple line, was down here at about 55%, and offers were up almost at 68, 70% of normal. Here, the marketplace was much faster than it is now. And, another way to look at it too is basically this gray line has to be basically very low in order to be in an inventory limited marketplace. So I don't buy that for a moment. There have been potentially times when we've been there, but we've had a DUI. Right now, I'm guessing that days of unsold inventory is probably somewhere around 40. We've had days of unsold inventory down around 20. We clearly have had a market that's turning over twice as quickly, so there's no way to support the hypothesis that we're in an inventory limited marketplace. And then the ratio between the two, the speed of the marketplace is basically absolutely normal right here at 100%. You can barely see it underneath the black horizontal line. The big thing is we have a lack of inventory, we have a lack of offers, we have a bigger lack of offers than we do of inventory. So it's the lack of transactions was probably the biggest story, but the market's behaving pretty much normally. Here now is looking at the inventory. Here you're taking the inventory in the purple line. The red line is the least amount of inventory you'd expect, and that's based on the past 10 years in the 10 percentile. The blue thin line up on the top is the most inventory you'd expect. You can see that we're falling down as you typically do at the end of the year for the end of the year holidays. Absolutely normal to have this cliff drop off of inventory, and I'd expect that drop off to continue. And if you look, it continues into about the first week of the following year. So we're in for this for another month and a half of decreasing inventory week after week. Here is inventory compared to normal. And despite that drop off in the previous chain, you can see there's been essentially no change here compared to normal. So that's your indication that you're going at pretty much the normal rate. Here is the number of offers, and I apologize. I know what's wrong with my data, but I can't access it to update it. So we don't have the last week's data point on here, but I will represent to you that it's down between the black line and the blue line. It's behaving exactly normally, exactly what you'd expect to do. One thing to keep in mind is I don't look at pending transactions. I look at offers accepted. The reason I do that is if you're looking at the transactions that are pending in escrow, a long-term transaction is going to impact your data for longer than that short-term transaction. I would believe it's important that each transaction has an equal weight on the statistical data. Now you can see here that I am plotting the last data point, and it is basically unchanged from last week. We're at 80% of the normal level of offers that you would expect. Here's your days on sold inventory. And again, you can see you're right on the line. I mean, for the last quarter, since basically October 1st, you can't trace a line more accurately than we're tracing the gray line with the purple line. This says that as we get a little closer into the new year's, just before the new year's, you'd expect this to turn around and go the other direction. But right now, we're somewhere around 34 days on sold inventory. exactly where you'd expect it to be. If the market was hot, you'd expect it to be down here around 22. You can see some of the the hot times is right here, basically at the end of 2021, beginning of 2022, and early in 2021, we were much faster paced marketplace. So here you might have been able to argue that the number of offers was being limited by the inventory, but you can't make that same argument when you're up here. Here you can see you're basically right at 100%. So that's, the theme of this week is you're having an absolute normal marketplace. Here's marketing time. Yes, marketing time is increasing. We're currently at 32 days, but it's exactly where it should be for this time of the year. So even though the market's slowing down and sellers are taking longer to sell the property and have been taking longer and longer to sell their property all the way since halfway through second quarter, that's exactly what you'd expect to do. Yes, we were a little bit longer going into third quarter, but in fourth quarter, we've been doing the normal trend. So again, the big takeaway is the market's behaving sort of absolutely normally. What caused this sort of slowdown in third quarter? Some people have hypothesized that it was the uncertainty on broker compensation. That may have been it, but to me, that's been a non-issue. So I can't imagine it impacting the marketplace. But if the consumers and the sellers and the buyers were concerned on what it was going to do to their individual situation, that may have had the impact. And when people don't know what's going to happen, they tend to stay put. Here's the normal line, so you can see that you're basically right at normal, following the normal trends. You can see that we were slower earlier in third quarter. We improved, and now we're basically right at normal. Here's largest price reductions. So because the vast majority of the sellers take no price reductions at all, on this particular graph, I'm looking at only the 10% of the sellers that are taking the biggest price reductions. Now, in statistics, you're not supposed to look at the fringes of your marketplace. But when you have a data point where 85% of your inputs aren't impacting your data at all, you want to sort of eliminate that 85% that's all zeros because otherwise it's going to mask changes. So here I've been looking at only the 10% of the sellers that are taking the largest price reductions, and you can see they're taking right at 13% price reductions. So those sellers that are taking the largest reductions in order to get the offer in the door are knocking off 13% off their original asking price. And that's average, which means some of those 10% are way above that 13%, and others are going to be a lot less than that 13%. Here you can see that we're taking larger price reductions. We're in the blue shade, which is always favoring the buyer. So you're taking more price reductions than normal. We had a huge improvement last week. Why you had a 1 week improvement is pretty weird, especially when you acknowledge that I use a 5 week moving data set. So this 1 week here, 80% of the data was the same as the week before, and 80% of the data from last week is the same as this week. So you had to have a few people that were taking very, very limited for reductions, and now you've recovered that to have that kind of swing in 1 week. And one of the reasons I use 5 weeks is to eliminate the swing, and also gives you essentially a moving monthly period of time for your data set. Now we're looking at the average, so you can see that I'm not really playing around with data. The average price reductions has basically been right at normal. Now you're a little bit on the lower side, less price reductions than you expect. You can see you're at about that 0.995 number where sellers are taking about 0.05% less. Essentially your 1% price reductions is what the average sellers were doing. Here you can see you've been going less and less price reductions on the average. So sellers are taking smaller and smaller price reductions. That bodes well for the market improving and, getting better gradually all the way through 2024 that we're in currently. It also bodes well, in my opinion, and there's no way to predict the future, but based on the fundamentals of the marketplace now, it looks like 2025 should be a very normal year, which is rapid appreciation early in the year. Here's the ask price reductions frequency. So we're looking at how common it is. And you can see only somewhere around 17% of the sellers are doing price reductions. That's fewer price reductions than normal. Normally at this time of the year, you're up here at about 20%. It has been climbing, but you can see that right at the beginning part of this fourth quarter, there was a reduction in the frequency of price reductions. Here you can see that reduction coming down off the gray line. You were basically normal amount of price reductions. And then a little bit before the beginning of fourth quarter, there was this huge improvement in reduction of sellers. And right now it's only about 85% of the sellers that normally take price reductions are taking price reductions. Here is the median overbidding. So how much is the overbidding? And this was the answer to what we were looking for before. It's coming on. It's a little bit above 3%. It's not at 3.5%, which would be up here on that faint horizontal line. So you're about 3.1% for the median. Median is the midpoint where half the buyers that are making offers are overbidding more than 3%, half are underbidding. And when you underbid, you're underbidding 3%. You might be underbidding at 1.1%, or you may be at 98%. This is all transactions, not just the overbidding. So it's the median bidding of all bids. And right now that's 3% over the seller's ask price. And this is for Silicon Valley, Santa Clara, Alameda, and San Mateo counties. This now is looking compared to normal, and you can see that there's been more and more overbidding. So the magnitude of overbidding is greater and greater. That's why the line's been increasing. This is the frequency of overbidding, and the frequency is also favoring the seller. So frequency and magnitude of overbidding are both increasing, which is the strong fundamentals that I mentioned earlier of the marketplace being reflected in what the buyers are doing when they find the house they want to purchase. And here you can see the decrease in frequency because it's going towards the hot marketplace. Here's the long-term appreciation. The blue or gray vertically sloped line is sort of the freehand rate of appreciation. You can see that we came down and now we're basically following the sloped line. The decrease appears to have occurred earlier this year than it typically does. Here's the monthly mortgage payments for the cheapest 10 percentile home, the median price home, and the most expensive. I will focus on the median this week. Basically, what I do is assume that you're putting 20% down, getting an 80% loan at the national rate. You can obviously do better than that by shopping around, by doing an adjustable rate loan, by putting more money down, and those kinds of things. But here in Silicon Valley, the typical payment's about 12,500. Right, the 12,000 would be the horizontal line right here, 13,000 here. Actually, it might be about closer to $12,750. And I also put in estimates for property tax and fire insurance. Now what we're doing is looking at the days on market distribution. So you're looking at the blue line, which is a year ago line, and this is every transaction. So 90% of the sellers were sold by the time they got to 50 days. 75% of the sellers were selling in something like 28 days. The purple is this week's data, so this year's data is quite a bit cooler, higher numbers. It's taking longer this year than last year, just comparing the 1 year over the 1 year. But we start off a year ago. You can see we jump it roughly a month at a time. They're all 4 and 5 weeks because I don't do anything on a monthly day basis. And then when we get to 13 weeks ago, we jump 1 week at a time. There you can see the market really slowing down. That's what you can expect to happen this year. Then when you get into next year, it's going to accelerate. That was the peak of the marketplace. Now it's slowing down. And then basically starting, that was July 26th, and I think it's earlier than that, but you're basically in the summer doldrums where you really don't move much. And now, again, when we get to the recent data, you can see we're all the way into October and the data is still where it was in July. But right there, you're going to start slowing down. So this is the end of the year's cool down that you see. We are seeing the cool down that we have every year, and the cool down is fewer sellers, fewer buyers, less activity, but not necessarily less overbidding. Now we're doing the same thing with ask price reductions. You can see here's where we were a year ago, much cooler. The purple line's above, so we're having fewer price reductions, smaller magnitude of price reductions. And this is the distribution. So this is every transaction. I go up to 2.5% of the sellers, and then only up to 17.5%. And the reason I stop at 17.5%, you can see almost every one of my lines is right at 100%. So nobody from here to the further to the right is all zeros. Now, last year there was more data, but this year and in recent weeks and months, there really isn't any data points other than zeros that I've truncated. Moving on and just watching it go. Here's the slowdown. There, that was only one, and now you're already up here. There's the peak of the marketplace 7 months ago. Here's your slowdown because this is sort of the overshoot period. Here's sort of the summer doldrums where you're just moving along at whatever the market's doing for the year. You can see it was back in September 6th, I think it was, we were back on top of the purple line, but that was the low point. You can see you're really not moving very much. That was sort of the high point. So there's little fluctuations. Now you're starting to move down, and right there's the end of the week. Now, ask price reductions, nobody's really in control with those, so that's an interesting metric to watch out. Here is the overbidding. This is what the buyers do. Again, the purple line is a little bit above, especially on the left-hand side here. The vast majority, or two-thirds of the buyers did exactly what they did last year. It's only the one-third that's overbidding the most. The one-third that's overbidding the most is overbidding a little bit more. Again, you're going to see the same pattern where initially we start off on the blue dotted line. We go down here, we hit our bottoms, we turn around, we hit our peak. These spread out as what I call the overshoot for the year, and we spend most of our year right here, right to where about where we are now. But here, watch it. There's the coolest. Now you have a rapid succession up in overbidding. There's the peak. Now you're coming down. Now you're already at the summer doldrums, just moving along. And doldrums is not a good word to use because the market's not necessarily slow, but it's really unchanged. You can have a very fast-paced summer marketplace. You can have a slower summer marketplace. But now you can start seeing right about there, you're going to start seeing the slowdown. And one of the reasons it really isn't showing up here is overbidding requires the close of escrow for the sold price to be revealed. So there's a 3 to 6 week time delay on this. And at this time of the year, that time delay is probably about 5 weeks. Here's now looking at the three counties. You have San Mateo County in the orange, you have Alameda County in the gray, Santa Clara County in the blue. You can see everybody's inventory is dropping down. When you see this, you might be alarmed, but all you have to do is go back and see that it goes down every year at this time, which is why I plot a lot of the data we've already seen compared to the 10-year typical. Here's offers accepted. Offers accepted aren't dropping down yet, but you can see they're slowly coming down. So they're going to start coming down more rapidly. Here's your days of unsold inventory. The market's actually going down, which is an improving marketplace. Look at Santa Clara County, for example. We've gone from that 40-day of unsold inventory basically just before the beginning of the quarter. So somewhere around the middle of September, maybe Labor Day. And now you're all the way down here at 26 days, it looks like. So that's a pretty significant improvement. It's probably the biggest improvement. San Mateo County's improved from something like 48 days to 38 days, maybe 37. And Alameda County's improved from about 57 days down to 42 days. So everybody's improving at this time of the year. Marketing time, everybody's increasing, but there is one exception. San Mateo County did a little improvement, not significant, a 1 week improvement. The trend is still up in the recent time frame for this quarter, but I would say that marketing times is increasing at this time of the year for the people on the market. And that's in part because the properties that are on the marketplace with so few sellers coming on have been the ones that have been picked over by the marketplace already. Here's the magnitude of price reductions. You can see that the largest price reductions are happening in Alameda County, the gray line here, just over 1%. The least amount of price reductions is in San Mateo County at somewhere around 7.5 tenths of 1%. So about 3/4 of 1%. And Santa Clara County is at around 9 tenths of 1%. Here's the frequency of price reductions. Alameda County is the most frequent price reductions, followed closely by Santa Clara County, both very close to around 17.5, 18%. And the area that's doing the least price reductions is San Mateo County at 14% of the sellers doing a price reduction before they accept an offer. Here's the overbidding. This is the average overbidding, and you can see that San Mateo County has the least overbidding at 4.5%. Santa Clara County is next at 5.5%. And Alameda County has the most overbidding at 6.5%. And that might be unusual with them having the largest price reductions. But again, my theory is those sellers are doing those price reductions, and then buyers are going, wow, that's a great price now. Let's go in and bid. Oh, there's multiple offers. Well, let's overbid. It's not unheard of, but it's interesting to see that the market that looks to be the slowest has the most aggressive overbidding from the buyers. Here's the frequency of overbidding, and you can see that your San Mateo County has the least frequent overbid. Santa Clara County is next, and as I was saying, Alameda County has the most frequent overbidding at about 69% of the transactions overbidding. Here's your long-term appreciation. You can see San Mateo County and Alameda County are very close together, and then Santa Clara County is higher at the most. So now you're looking at sold prices long term on log paper. You can see that San Mateo County has the highest price. Santa Clara County is the next, and Alameda County is the most affordable area at just about $1.3 million for their typical median priced home. Here's the same information on regular paper for those that prefer it. Here's estimated payments, so the order is going to be the same because they all go through the same formula. Again, I'm using the national average for an 80% loan, adding in property tax. Here's looking at micro market areas. Each one of the areas you have Silicon Valley, which is all three counties, then you have Santa Clara County, and then you have the seven micro market areas in Santa Clara County. Then you have San Mateo County and the six micro market areas in San Mateo County, and then Alameda County, and then the seven micro market areas. For the first three slides, I only have Alameda County wide data. I don't have micro data. You can see that only Foster City, very small area, is a hot marketplace. So the only one that's I would consider to be hot is the Campbell, Cambrian, Santa Clara, Willow Glen, and it's at 70% roughly of the number of inventory. Everybody else is very close to 100%. We have Morgan Hill at 103%. Everybody else is just below 100%. This is very clearly one of the clear pictures where you see blue across the board in most areas, a lack of offers. 80% in Alameda County, 81%, 70%, 77%, 84%, 82%, 68%, 75%. And then the other areas are white in color. There's no area where they're getting more offers than normal. But there is one at 103%, but I consider anything up to 112% to be normal. So Cupertino's got the most activity going at 3% above the normal level of offers. Looking at the speed of the marketplace, Redwood City is the slowest area at 32% slower than it typically is. That's pretty significant. Morgan Hill is at 20% slower. And then Campbell area again is 85%, 15% faster than it normally is. Here's the actual raw numbers so you can see what the market is. Look at Atherton, 114 days of inventory in Atherton. Oakland at 98 days. But for the most part, these are red in color, so the market is fast. And that's one of the things that people coming into the Silicon Valley need to pay attention to, is Silicon Valley is a fast moving marketplace. Here's marketing times. How long is it taking to sell? Again, a lot of red. The Atherton area is 62. You might ask, how can you have 62 when the previous slide was 114? It's basically there's a lot of sellers that are coming on the marketplace counting as inventory but not selling, and so their days on the marketplace are lower. Here's ask price adjustments. You can see that in Milpitas, the one area that's standing out as a hot marketplace is actually going in over the seller's ask price. Everybody else is below, and you can see a fair amount of blue again in here, basically indicating a cool marketplace. Frequency. So even though the previous slide was blue, indicating magnitude of price reductions was high, the frequency is pretty low. Less than 1 in 7 sellers, less than about 1 in 6 sellers are taking a price reduction or less than that. Here's the magnitude of overbidding, and this is the average. And so you can see you have what's Milpitas. Milpitas is at 4.6%, but Cupertino is at almost 10% overbidding. And come down here and look at Alameda County and Berkeley is 14. And Oakland's interesting, even though it was long, it's got overbidding at almost 10%, 9.5%. Here's the frequency of overbidding. So very common overbidding. So buyers are not afraid to overbid, at any time in the marketplace in Silicon Valley. Here's the long-term appreciation. Blue is the least amount of appreciation. The redder the color, the more appreciation there are. So you can see it's sort of the outlying areas that became more desirable with the pandemic that have the most appreciation. That's very typical where the area that's had the most appreciation recently it has the highest overall because of compounding. Here's affordability. The middle number is the sold price. Number to the left is the cheapest 10%. Number on the right is the highest 10% in that given area. So you can see where the more affordable areas are, and in red, you can see where the more expensive areas are. Here's a summary. You can start off on the left-hand side if there's a particular geographical area that you're interested in, or you can start off with the monthly payments or your purchase price range and see what the market conditions are in each one of the 20 micro market areas. Here's the data for people that actually like to see the board. You can see we're basically seeing a 10% reduction in the new listings in the last week. And the inventory is being dropped by about 15%, so you can see how much that drops down. Offers are being dropped by 4%. So you can just see across the board that what the impact of the holidays are. 1,905 transactions, the fourth slowest in the last 25. 2022, 2023 remain the slowest two. 2007 off the chart because it's more than 10 years ago is the third, and we're at the fourth slowest year. So yes, sales have improved from last year, but we're still fairly low in the number of offers that you would expect to see the number of transactions. We've been talking about the Silicon Valley real estate marketplace. We will next be going into the Greater Bay Area, which I look at 13 counties in Northern California, broken into 5 regions. The blue is my YouTube. We've been talking about the Silicon Valley real estate marketplace. We will shortly be talking about the Greater Bay Area, 13 counties, 5 regions. I'd appreciate you liking the video and subscribing if you haven't already. To get to an archive, you type in the blue YouTube URL. For shorter typing, just type in the green root URL, it takes you to the same location. On Saturday morning at 9 a.m., if you type in the green root URL plus 2024, you get to the live presentation and you can participate and ask questions. For the handout, 67-page handout of the PowerPoints that we've gone over, type in the green root URL H 2024, the month 11, day 23, and you'll get this week's handout electronically through PDF if you want to download it. And then for any specific episode, the green root URL, the year, month, date code. I'm Richard Calhoun, real estate broker here in Silicon Valley. Here's my contact information representing buyers or sellers in a single transactions. And again, please consider subscribing and liking. Moving on to the Greater Bay Area, 13 counties. These are the 5 regions we talked to them about. Silicon Valley is the first one. Then we add in the cities, San Francisco and Marin, North Bay, Central Valley, and the Central Coast. Here's the inventory, and you can see inventory is rolling down now in all 5 regions. The Central Valley was probably the least to go down, and it's now rolled over and it went down at least for this week. And with the approaching holidays, it will be most likely going down. What's noteworthy is that Silicon Valley seems to be the area that's coming down the steepest amount. Historically, Central Valley and North Bay look like they come down the same amount. So why it's delayed this year compared to where it normally drops off, I have no explanation for, but it does appear that the level of inventory is remaining higher in both the North Bay and the Central Valley than it would typically expect. Here's the number of offers accepted in the past 5 weeks. Again, Silicon Valley is going down. North Bay is actually going up. And if you look back in time, that is not the pattern that you typically see for the North Bay. North Bay has been going up all quarter and continues to go up, including this last week. Central Valley is drifting down. The cities is drifting up and is getting to be some of the highest sales volume it has had in the last 2 full years. You have to get back to 2022 to have noticeably more transactions. And then Central Coast is sort of just puddling along with the level of transactions. So again, Silicon Valley appears to have dropped the most as far as offers in the past 5 weeks. Days unsold inventory is sort of the seller inventory demand balance, seller buyer balance. The one that's coming down the most, which is an improving marketplace, is the cities. Look how much that's dropped down. Next most is probably North Bay with it improving as well. Silicon Valley is probably in third place. Central Valley is sort of flat, and Central Coast is sort of flat. And again, the lower the number, the faster the marketplace is. So the cities has improved or accelerated almost in half. It's gone from about 82 days up here down to about 45 days down here. So not quite in half, but approaching 50% or twice as fast as it was just about 14 weeks ago. Here's marketing time, the time to market. And what's interesting is even though the days unsold inventory is dropping in the cities, the actual marketing time for sellers is increasing. And with those two happening that strongly, I suspect what's happening is the homes that are selling have been homes that have been on the market for a while, increasing the marketing time of the properties that are selling. All the areas are increasing except for the Central Coast, which is drifting slightly slower. So a slightly faster paced marketplace. But when I say slightly, I'm talking slightly. You basically went from 60 to 58 days. So only improvement of two less days, where the city has gone from basically 30 days to sell your home to 48 days to sell your home. That's a fairly significant slowing down, 50% longer to sell. Silicon Valley has slowed down, but not nearly as much from basically 26 days to 62. So that's only a slowdown of about 25%. Here's your price reductions the sellers are taking, and this is average. So again, very small number. The Central Coast is taking the most price reductions at almost 3%, 2.5%, 2.8% price reduction, 2.6%, but it's been pretty flat. North Bay has been increasing price reductions, Central Valley increasing price reductions, cities basically flat, and Silicon Valley's basically flat. Silicon Valley is taking the least amount of price reductions at a little less than 1%, probably somewhere around 0.95 of 1%, 95% of 1%. Here is the frequency. Look at the frequency increase in the cities, which is sort of interesting. The cities is market speeding up, but sellers are taking more and more frequent price reductions. Now, basically, 1 in 4 sellers in the cities is doing a price reduction. Compared to to Silicon Valley, where it's only about 17%, which is only about 1 in 6 sellers are doing a price reduction. The area where there's the most price reduction is the Central Valley, with almost 40%, 38% of the sellers doing a price reduction. The Central Coast and North Bay both come in at 1 out of 3 sellers is doing a price reduction. This is the magnitude of overbidding. You basically have the most overbidding in the cities, followed by the Silicon Valley at somewhere around 5.5% overbid. Then you drop way down into the North Bay of only about 0.75%. Central Valley is a tad, just a small sliver below 100%. And then Central Coast is a full percent below the seller's asking price. Here's the frequency of overbidding. So how common is it? Central Coast is only 3 out of 10 buyers are overbidding. You go all the way up to Silicon Valley where it's 66%. So two-thirds of the buyers are overbidding in Silicon Valley. Cities is at 58% of the buyers are overbidding. Here's the long-term appreciation. It's been a broken record here. The cities is by far the least amount of appreciation and only 40% since 2015, which isn't bad. You know, it's basically 10 years appreciation, 40%, 4% a year without worrying about compounding. But then if you put your 20% down, your rate of return on your own investment is 5 times that. So that 4% raise becomes a 20% return on your actual cash investment. But then you go up to areas like you got a three-way tie here with Central Coast, Silicon Valleys, and Central Valley at somewhere north of 90%. I think there's a little variation because I think Central Valley's popping down here at 88%, Silicon Valley's at 90, and Central Coast is about 93.5% appreciation. And that's on top of your original investment. And then, of course, North Bay is down here at 68%. Here's the median price. Silicon Valley and the cities are very close together. And again, this is all 3 counties for Silicon Valley, and then the cities is just San Francisco and Marin. Central Coast is in the middle of the pack, then North Bay, and the most affordable region is the Central Valley. Look how stable prices are in the Central Valley compared to the swings in the cities and in Silicon Valley. And then probably the most volatile one is the Central Coast, and a lot of that has to do with whether properties are selling in places like King City along the 101 corridor or along the Monterey Santa Cruz coastline. Here's the estimated payments. Their order is going to be the same. This is assuming an 80% loan using an estimate for property tax and insurance, so it's your total payment. Here's the actual raw numbers, the metrics across the top, the different counties down the side. In addition to the 13 counties, I have the region of Silicon Valley, and I do have the Bay Area. I have it in here, not that I believe it's a good number. In fact, I believe it's a bad number. It's because the media talks about it so much. And let me pick an example of why I think it's such a bad number. And let's just go over here to the frequency of overbidding. Here you'd say just a little over 50% of the sellers are getting overbids, but it varies anywhere from a low of 17% in Napa to a high of 69% in Alameda County. And one number of 56 doesn't reflect that wide range that you have. And when you're buying a property or investing in a property, you're only investing in one property. You're not distributing the investment across the Bay Area. So it's a garbage number, but it's in here for comparison purposes, just in case anyone's curious. And it gives you some sort of idea of what's happening. But again, like on appreciation, 82% appreciation sounds pretty good. But if you're in Napa, you're at 40%, so you're half of that. And if you're up here in Santa Clara County, you're at 101%, so you're 25% greater appreciation than the Bay Area. Not seeing any unmuted mics. Have a great week. Take care. Bye for now.